On July 4th, 2025, America's hotels sold more rooms in a single day than at any point in history. Yet, just weeks earlier in June 2025, U.S. travel spending recorded its first year-over-year decline since 2021. How can two completely opposite realities exist at the same time? Is this simply a seasonal quirk, or a warning sign that the post-pandemic tourism boom is losing steam? Some point to Trump Tariffs 2025 as a new drag on the market. Others blame rising visa fees, which are making trips to the U.S. more expensive for international travelers. And let's not forget the broader global slowdown, where higher interest rates and energy costs are reshaping travel budgets worldwide. In this video, we'll break down 6 key industries being hit hardest by this uneven tourism landscape. We'll bring you the most recent data, straight from trusted industry sources, and we'll map out the critical 60-day outlook so you can see where the next shifts might come. Because understanding what's really driving this split could tell us whether the industry is facing a temporary dip or a deeper, longer-term reset. 2025 Snapshot: Data and Key Risks. From June to August 2025, TSA checkpoint data shows a 7-day average of 2.6 to 3.0 million travelers per day. That's historically strong traffic, yet it hasn't translated into more money. In June 2025, the U.S. Travel Association reported a 0.4% year-over-year drop in travel spending, the first decline since early 2021. STR hotel data confirms demand is essentially flat in many major cities, with small dips in a few urban markets. Business travel is also under pressure. The Global Business Travel Association's July survey found many companies cutting budgets, citing trade tariffs and higher visa fees. Restaurants in tourist hubs are feeling it too. OpenTable data shows bookings down 8 to 15% compared to last year, hitting cities that depend on both domestic and international visitors. Key risks ahead include rising fuel prices that could push up airfares and transportation costs. High interest rates may further squeeze discretionary spending. Visa policy changes and trade disputes could alter the flow of inbound travelers. And if consumer confidence weakens, today's mild slowdown could become a deeper challenge for the entire U.S. tourism economy. Number 6. Hotels and Lodging. According to the Las Vegas Convention and Visitors Authority, visitation to Las Vegas fell 11.3% year-over-year in June 2025. Yet on July 4, 2025, hotels nationwide set an all-time record for the most rooms sold in a single day. This contrast highlights a fragmented demand pattern, sharp spikes during major events and holidays, but noticeable dips during regular weeks. Rising room rates, resort fees, and higher operating costs are key pressures shaping booking decisions. City center hotels that rely heavily on MICE meetings, incentives, conferences, and exhibitions are feeling the brunt of the slowdown. In contrast, resorts and event-driven markets are holding up better, benefiting from concentrated surges in demand. Travelers sensitive to price are seeking alternatives like vacation rentals, budget hotels, or staying with friends and family. Urban properties are experimenting with deep discounts, loyalty perks, and value-added packages to protect occupancy. Resort destinations are focusing on maximizing high-demand periods while controlling costs in off-peak weeks. Key metrics to watch include STR weekly data comparing urban and resort performance, as well as the upcoming convention calendar for late 2025. Number 5. Airlines and Air Travel. Southwest Airlines recently cut its Q3 outlook, citing weaker demand in price-sensitive leisure markets. Meanwhile, United and Delta are reporting stronger revenue growth from premium cabins, supported by both corporate travelers and affluent leisure passengers. This marks a clear shift in profitability from the back of the plane to the front, where higher fares and premium services drive stronger margins. Corporate travel budgets and the growing appetite for high-end leisure experiences are the key drivers of this trend. Low-cost carriers, LCC, and ultra-low-cost carriers, ULCC, are feeling the most pressure as fare-sensitive travelers cut back or choose alternative transport. Airlines are redeploying capacity toward premium-heavy routes, both domestic and international, while trimming schedules in purely price-driven markets. The ripple effect extends beyond the airlines themselves, impacting airport retailers, catering services, and ground handlers when economy-class volumes drop. Fuel price volatility adds another layer of uncertainty, as higher costs can erode already thin margins in competitive markets. Metrics to watch include RASM and PRASM for yield trends, fuel price movements, and load factors across domestic versus international routes. These indicators will reveal whether the current market split widens or begins to rebalance in the months ahead. Number 4. Restaurants in tourist hubs. OpenTable data shows restaurant bookings in major tourist hubs fell between 8% and 15% year-over-year in July 2025. The sharpest declines are in venues that depend heavily on international tour groups and large parties. Losing these high-spending groups has reduced average ticket sizes and cut sales of premium, high-margin menu items. Rising travel costs, higher visa fees, and ongoing food inflation are key drivers behind the slowdown. Fine dining establishments that rely almost entirely on tourist traffic are among the most vulnerable. Many have tried pivoting to local customers with discounts, prix-fix menus, and daily specials, but in many destinations the local base is too small to sustain pre-slowdown volumes. The impact ripples through the supply chain, affecting farmers, fishermen, and specialty producers who supply these restaurants. Some skilled chefs and hospitality workers are leaving the industry, creating talent gaps that will be difficult to fill when demand returns. Key metrics to watch include weekend and holiday booking levels, as well as demand for group dining and event catering. These indicators will help determine whether the downturn is temporary or part of a longer-term shift in dining trends within tourist-heavy areas. Number 3. Attractions and entertainment. Disney parks have maintained steady revenue in 2025, supported by strong brand loyalty and global recognition. In contrast, Six Flags has reported declining attendance and lowered its financial outlook for the year. Broadway theaters in New York City are operating at roughly 90% capacity, showing resilience in both domestic and international demand. The key driver behind this divide is the strength of intellectual property and brand equity versus reliance on purely regional appeal. Top-tier brands with beloved characters, immersive experiences, and global marketing power are holding their ground even as travel costs rise. Second-tier attractions, especially those dependent on regional visitors and large group bookings, are facing greater headwinds. Price sensitivity, fewer school trips, and reduced discretionary spending are hitting these venues harder. Merchandise sales, sponsorship deals, and special events remain robust for market leaders, giving them more financial stability. Meanwhile, smaller or regional attractions must innovate aggressively through seasonal events, unique experiences, or partnerships to compete for tourist dollars. Key metrics to watch include the launch schedule for new IP-driven attractions and international family booking trends for major theme parks and cultural destinations. These will be early indicators of how quickly and for whom the sector will rebound. Number 2. car rentals, and local transport. Hertz reported a slight year-over-year revenue decline in 2025, but boosted vehicle utilization by streamlining its fleet to match actual demand. Avis outperformed expectations, posting EBITDA growth through tighter cost controls and a stronger focus on premium, high-demand markets. Tour bus companies and sightseeing operators have been hit far harder, with steep declines in passenger numbers and some closing operations entirely. The main drivers of this split are the volume of inbound international travelers and volatile fuel prices, both of which directly impact operating costs and demand. Premium airport rental locations in major business hubs or luxury destinations are holding up better, supported by travelers willing to pay for convenience and flexibility. Ride-hailing drivers in tourist areas are struggling as trip volumes fall while fuel, insurance, and maintenance costs remain high. Public transportation systems in tourism-heavy cities have lost significant fare revenue from international visitors, forcing some to weigh fare increases or service reductions. Key metrics to watch include inbound visa approval rates, as they often predict shifts in international travel flows, and the schedule of major conventions, festivals, and sporting events. These indicators will be critical in forecasting when demand for rentals and local transport could see a sustained recovery. Number 1. Retail in tourist districts. Times Square continues to attract an impressive 200,000 to 250,000 visitors per day in 2025, but high foot traffic does not necessarily translate into strong sales. Many retailers report that spending per visitor is lower than in previous years, with more people browsing, taking photos, and enjoying the atmosphere without making large purchases. Key drivers of this trend include softer consumer incomes in certain markets, higher prices across the board, and a growing shift toward e-commerce for both domestic and international shoppers. Luxury retailers and boutique stores that rely heavily on high-spending international visitors have been hit the hardest, especially with fewer tourists arriving from markets like China and the Middle East. On the other hand, experiential retail outlets, stores offering interactive displays, limited-time events, or products tied to major shows and attractions are managing to maintain steady engagement. Some store owners are introducing exclusive in-store experiences or local collaborations to draw customers back into physical locations. Key indicators to watch include seasonal sales performance and inbound visitor trends from Asia and Europe, which are often critical to big-ticket retail purchases. These factors will help determine how quickly tourist district retail can rebound to pre-slowdown revenue levels. City Snapshot: Las Vegas is New York versus Orlando. Las Vegas has one of the most tourism-dependent economies in the United States, and its reliance on MICE, meetings, incentives, conferences, and exhibitions, makes it highly sensitive to market cycles. When large conventions or corporate events soften, hotel occupancy, average daily rates, and gaming revenues often decline in tandem. The city's heavy dependence on event-driven and high-volume travel means downturns can hit hard and fast. New York City, by contrast, benefits from a diverse mix of visitors, domestic leisure travelers, international tourists, and a strong cultural and entertainment scene. Broadway theaters, museums, and iconic attractions help keep demand steady, even when one segment, such as international arrivals, faces headwinds. This diversity allows NYC to absorb shocks more effectively than single-source destinations. Orlando stands out for its powerful intellectual, property-driven attractions, with Disney World and Universal Studios acting as global magnets for families and fans. These flagship parks have helped the city recover faster than many second-tier markets, as loyal visitors are willing to plan trips despite higher travel costs. The lesson is clear. Destinations with multiple visitor streams and strong brand anchors can withstand downturns better and rebound more quickly when conditions improve. 60-day dashboard and scenarios. Over the next 2 months, several key indicators will determine the trajectory of U.S. tourism. STR weekly reports will reveal how hotel occupancy, ADR, and REVPAR are trending across urban and resort markets. TSA's 7-day average passenger counts will provide a near real-time pulse on travel demand. GBTA business travel updates will indicate whether corporate budgets are loosening or tightening further. Quarterly airline earnings will show which carriers are successfully capitalizing on premium demand and which are struggling in price-sensitive segments. Inbound visa approval data will offer clues on the flow of international travelers, especially from high-spending regions. In the base scenario, the market remains fragmented. Premium segments hold steady, while budget travel stays soft. In the upside scenario, lower fuel prices and the return of large-scale MICE events drive a broader recovery in both urban and leisure markets. In the downside scenario, rising visa fees and higher oil prices prolong weakness in budget-conscious travel, keeping pressure on airlines, hotels, and local businesses. Monitoring these metrics closely will be critical for anticipating shifts and adjusting strategies in real time. What it means for workers and small business? For workers, the tourism slowdown means fewer hours, smaller tips, and reduced seasonal job opportunities. Frontline staff in hotels, restaurants, and attractions are often the first to feel the impact as shifts are cut to match lower demand. Seasonal workers, who depend on peak travel months, may struggle to find consistent income, especially in destinations with sharp off-peak declines. Small businesses in tourist districts face similar challenges, with fluctuating foot traffic and unpredictable revenue streams making planning difficult. To adapt, many are offering bundled packages that combine lodging, dining, and experiences at a discounted rate. Dynamic pricing is becoming more common, allowing businesses to adjust rates based on demand patterns in real time. Some are partnering with local organizations and events to attract both residents and regional visitors, helping to offset the drop in long-haul tourist spending. Flexibility and creative outreach will be key to surviving until the market stabilizes. Tourism in 2025 is a story of clear winners and losers. Some industries and destinations are thriving on premium demand and brand strength, while others struggle with price sensitivity and shifting travel patterns. The big question now is this: are Trump tariffs 2025 and higher visa fees just a short-term shock, or are they the beginning of a longer-term restructuring of U.S. tourism? We'd love to hear your thoughts. Drop your comments below. Share this video with others, and don't forget to subscribe so you won't miss our next in-depth breakdown.